Hello and welcome. My name is Jake Adams, a CPA with Realtor Tax Strategy and Adams ABC Accounting Services. Today we're going to spend about 10 minutes talking about what is a tax deduction. So this is everything you need to know about tax deductions. Exciting stuff, I know, but I'll try to make it somewhat interesting for you. So a little bit about me before we get started. So 10 years ago I got my first 1099 miscellaneous form in the mail, and I had no idea what to do. Many of you that are starting in the real estate industry have either seen one of these or you haven't seen one and are going to see one very soon. So if you haven't seen the 1099 miscellaneous form, essentially what it is it's for commissions that are earned or self-employment income. So I had, of course, the first time I saw it, I had no idea what I was looking at. So I went to Jackson Hewitt because I thought it was cheaper than H&R Block, and I thought I was going to get better service or the same service at the same price or lower price. So I went to Jackson Hewitt, and the tax preparer there gave me no information, no support whatsoever, and I ended up owing over $4,000 in taxes, which to me at the ripe age of 20 something was 2 months worth of income. Shocked me. I had no idea what to do. And of course I had no money saved up because I didn't know that I was going to have this much in taxes. As a regular wage earner, I had always had my taxes withheld, and I usually always got a refund. So not to say that this was the only thing that made me become a tax accountant, but it was definitely one thing that pushed me in that direction. So I wanted to study as much about the tax code and about accounting as I could. And right after school I went to work at H&R Block so that I could help people understand their taxes a little bit better. So let's jump right into this and talk about what is a tax deduction. Well, when we're looking at tax deductions, there's different kinds of taxes. There's taxes that you pay every day, like sales tax. There's also taxes you pay yearly, like real estate taxes, that are either usually compounded into your mortgage payment, or you're paying them separately. But what we're talking about here is specifically for income taxes. And here in the great state of California, we have not only a federal income tax, but we also have a state income tax. And the brackets are going to start at 10%, and they top out at 39.6% for those federal tax brackets. And in California, we have lower rates starting at 2%, and they go up to 20.6%. So I have here a table that shows you the rates of the 10%, the 15%, 25, and 28. Those are all federal rates for single filers and married filing jointly filers. Now there's a couple other ways you can file. There's married filing separately, head of household, but we're not going to talk about those today. Those are a little bit more in depth, and we're just going to look at the majority of most of us are going to be either filing single or married filing jointly. You can see essentially what happens when you're married filing jointly is your brackets are approximately doubled, and they basically are looking at two people that would be filing singly, pooling their income together and filing jointly. So the other thing I wanted to touch on while we're looking at this is that if you make $91,151, so you're $1 over the 25% to the 28% on the single bracket there, that extra $1 is taxed at 28% instead of 25%. So that doesn't mean that by making that one extra dollar that all of your income is taxed at 28.28%. That's not what that means. You get to take advantage of the lower rates on that first $9,275 that you make, and you take advantage of the 15%, then the 25%, then the 28%. So what we do for tax strategy is we try to find a target zone, and your target zone is what you feel comfortable paying in income taxes and what is the most beneficial rate for you. So in this case, what we've done is we've marked the target zone there in yellow, And our target zone is between $18,000 and $75,000 worth of income. And when we're in that target zone, that means that our federal income rate is going to be at the 15% tax bracket. The self-employment tax is also going to be at the 15% tax bracket. So we're at a total tax rate of 30%, not including our state taxes. And again, you may feel more comfortable in the higher rate or the lower rate. But for this example, we've targeted here for a married filing jointly couple a target income rate or zone between the $18,000 and $75,000. So let's talk about the standard itemized deductions, which you probably have heard of before. There's your mortgage interest, your real estate taxes, and your charitable contributions. That's your goodwill, money for Girl Scout cookies, anything that you're going to donate as far as clothes or appliances or household goods. Probably already heard of those, so we're not going to touch on those. Some of the things you probably haven't heard of, or maybe you have, as far as the adjustments. And the adjustments are the tax deductions based on your tax rate. So if you remember back on the table that we were just looking at, we were talking about your tax rate. So if your tax rate is 15% in the 15% bracket, that means that your mortgage interest, your real estate taxes, your charitable contributions, and these other adjustments that we're going to talk about are worth 15% of their value, or 15 cents on the dollar. So some of the other adjustments that we could look at would be the student loan interest deduction, which is extremely limited. It's about $50,000 to $60,000. If you make over $50,000 or $60,000, you cannot take the student loan interest deduction. It's phased out. And there's also the HSA, the Health Savings Account. So if you have one, you've probably known that. If you don't have one, then you probably haven't seen that before. So what's the difference between a deduction and a credit? Well, a credit is a dollar for dollar tax savings. This is things like the American Opportunities Credit, the Lifetime Learning Credit, the Child Independent Care Credit. There's also the solar credits and some vehicle credits as well. And these are, again, dollar for dollar tax savings. So that means it doesn't matter what bracket you're in, as long as you have a tax liability of, let's say, $5,000, you could take advantage of $5,000 of the American Opportunity Credits. And those are going to reduce or potentially eliminate the tax that is owed. I hope that was informational and educational for you, discussing the tax brackets and how your income is taxed at the federal and state level. If you have any questions, please reach out to me. You can reach me at jake@adamsabc.com. And if you enjoyed this video, please subscribe and check out our other videos here on the channel.